For decades, financial institutions have been chasing an impossible dream, the ability to predict market crashes before they happen. This holy grail would allow investors to protect themselves, regulators to prevent systemic collapse, and institutions to position for catastrophe. In 2025, that dream is becoming a reality in ways that would have seemed like science fiction just 5 years ago. Artificial intelligence is developing the capability to detect financial market stress and dysfunction earlier than traditional methods ever could, offering genuine early warning that could save trillions of dollars and prevent the next financial crisis. Crucially, there is a growing body of evidence showing that artificial intelligence's ability to analyze large data sets and identify financial patterns can preempt crises, providing early warnings and enabling proactive interventions. This is not speculation or marketing hype. This is the consensus among academic researchers, central bankers, and financial regulators worldwide. Research suggests that artificial intelligence can significantly enhance the detection and prediction of financial downturns, with this data-driven approach enabling institutions to refine financial strategies, improve risk management, and ultimately strengthen economic resilience. When machines explain themselves, the most sophisticated AI early warning systems emerging in 2025 combine two complementary artificial intelligence approaches: recurrent neural networks that detect patterns and large language models that explain what those patterns mean. By combining recurrent neural networks with large language models, researchers developed a two-stage framework to forecast market stress and identify its underlying drivers. This combination addresses the critical problem that has plagued AI deployment in finance for years: the black box problem where the system makes accurate predictions but cannot explain why. The recurrent neural network detects periods of heightened triangular arbitrage parity deviations up to 60 working days in advance, effectively predicting market dysfunctions that may occur within a 1-month window. Triangular arbitrage parity is a technical indicator that captures dysfunction in foreign exchange markets. When this indicator breaks down, it signals that something is wrong in the financial system. Traditional models would struggle to detect this breakdown. Recurrent neural networks excel at it because they can process sequential time series data and identify when patterns deviate from normal behavior. Out of sample testing on 3.5 years of data demonstrates the model's practical value, with the model identifying elevated risks before the March 2023 banking turmoil. Despite being trained only on data up to the end of 2020, this is a remarkable demonstration of predictive power. The March 2023 banking turmoil, the collapse of Silicon Valley Bank, was completely unexpected by most market participants. Yet an AI system trained on data that predated the event by more than 2 years identified elevated risk signals before the crisis hit. During the March 2023 banking turmoil, the model flagged elevated risks in euro liquidity and cross-currency arbitrage, and guided by these signals, the large language model identified news articles discussing tightening dollar funding conditions and rising geopolitical tensions. This reveals how the system works in practice. The neural network identifies that certain variables are becoming increasingly important predictors of stress. It then feeds those signals into a language model that searches financial news and commentary to understand the economic narrative behind the statistical signals. The result is not just a prediction, but an explanation of what is driving the predicted stress. Transparent machine learning. At each point in time, the model assigns time, varying weights to input variables, automatically identifying which indicators matter most for predicting future market conditions. This represents a fundamental breakthrough in explainable artificial intelligence. Rather than using a fixed formula where variable X always has the same importance, the system dynamically adjusts which variables matter based on changing market conditions. Crucially, these weights are directly observable to supervisors, providing transparency about the model's decision-making process. Financial regulators require this transparency because they need to understand why the system is flagging risk. When the model suddenly increases the weight on a particular variable, supervisors can investigate why that indicator has become more relevant. This transforms the AI system from an opaque black box into a transparent tool that policymakers can understand and act upon. out of sample testing on 3.5 years of data demonstrated the model's practical value, with the model successfully identifying periods of market stress and identifying elevated risks before the March 2023 banking turmoil and October 2023 Treasury stress while pinpointing underlying drivers. The October 2023 Treasury stress episode was another moment when traditional models failed but AI systems succeeded. Treasury markets experienced severe dysfunction when the 10-year yield spiked rapidly, creating liquidity problems. An AI system predicted this stress in advance. Beyond simple rules, another breakthrough in AI early warning systems uses random forest algorithms, ensemble methods that combine multiple decision trees to forecast the full distribution of future market conditions. Random forest models outperform traditional time series approaches, particularly in predicting tail risks over longer time horizons up to 12 months. This is crucial because tail risks, the extreme, unlikely events, are precisely what matter most for financial stability. Market condition indicators were constructed for three key United States markets critical to financial stability: Treasury, foreign exchange, and money markets, with these indicators capturing dislocations in liquidity, volatility, and arbitrage conditions. The system builds indicators that reflect genuine market dysfunction rather than simple sentiment shifts. When these indicators spike, it means market structure itself is breaking down. What AI would have shown, the most striking evidence of AI's crash prediction capability comes from historical analysis of the 2008 financial crisis. Early models analyzing mortgage-backed securities and credit default swaps detected irregularities as early as 2006, with artificial intelligence models used by hedge funds identifying high default risks in mortgage-backed securities but failing to convince major institutions to act. This reveals both AI's power and its limitation. The systems detected genuine warning signals years before the crisis. By mid-2007, artificial intelligence-driven funds started shorting financial stocks, but most human investors remained optimistic. The AI systems made billions by correctly predicting the crash. Traditional investors suffered massive losses. Yet despite this predictive power, the broader market remained in denial until catastrophe struck. The accuracy that cannot be ignored. A 2023 study from MIT Sloan School of Management tested deep learning models on 40 years of stock data, finding that artificial intelligence correctly predicted 80% of minor market corrections. While this does not sound earth-shattering, 80% accuracy on something as inherently unpredictable as market movements is exceptional. Artificial intelligence is revolutionizing risk management in financial institutions, boosting predictive accuracy to around 85% for short-term market trends. A 2024 study analyzing the accuracy of machine learning algorithms in predicting financial distress found that artificial neural network models were 98% accurate in predicting financial distress in Toronto Stock Exchange listed companies. When you can predict something with 98% accuracy, you have information worth billions of dollars. The double-edged sword. The most uncomfortable truth about AI crash prediction systems is that they might actually cause the crashes they predict. Ironically, artificial intelligence itself became the center of a stock market crash in early 2025, with after a boom in AI-driven stocks in 2024, a wave of skepticism led to a sharp sell-off in tech stocks, and artificial intelligence-generated financial reports flagged overvalued artificial intelligence stocks, leading to mass sell-offs, with companies like Nvidia losing over $200 billion in market capitalization in a single week as artificial intelligence-driven funds exited their positions simultaneously. The sell-off was worsened by artificial intelligence models reinforcing each other's predictions, triggering a self-fulfilling market panic, highlighting the double-edged nature of artificial intelligence. While it can provide critical insights, over-reliance on artificial intelligence-driven predictions can create instability. This represents a profound paradox. Systems designed to prevent crashes might cause crashes if many institutions rely on them simultaneously. The limitations that remain: the ability of existing early warning models to predict turning points or nonlinear and interactive phenomena out of sample is still limited. This is the critical constraint. AI systems excel at identifying patterns within historical data, but they struggle with truly novel events that have no historical precedent. The model identified elevated risk before the March 2023 banking turmoil, but it did not predict the market anomaly caused by the onset of COVID-19. as the event's origins were completely external to the financial system. External shocks, geopolitical surprises, natural disasters, unexpected policy shifts remain inherently unpredictable. AI systems can only process information within the financial system itself. They cannot predict events outside finance. When predictions require decisions, as artificial intelligence reshapes financial forecasting and crisis management, robust governance frameworks become crucial, with the World Economic Forum's Artificial Intelligence Governance Alliance stressing the need for transparent and inclusive governance to ensure artificial intelligence's robust deployment. The greatest challenge in deploying AI crash prediction systems is governance. When a system predicts a crash, who decides what action to take? If regulators act too aggressively, they might trigger the very crash they are trying to prevent. If they act too slowly, they miss the window for intervention. The future of financial stability will depend on how well institutions balance artificial intelligence capability with human judgment. Institutions that balance innovation with compliance will shape a more resilient financial future. The AI systems that predict market crashes are not perfect, but they represent a meaningful improvement over traditional methods. The institutions and regulators that deploy these systems wisely will be better prepared for the next financial crisis. Those that ignore them will be blindsided when crisis arrives.